The stock of Varun Beverages, the Indian multinational company that manufactures, bottles and distributes beverages, has seen a significant correction of nearly 20% since January this year. Several factors have contributed to this decline, including concerns over disruptive pricing by Reliance-backed Campa Cola, Coca-Cola's restructuring in India, weaker international business and a slowdown in urban demand. These challenges have cast a shadow over the company's earnings prospects, leading to the recent dip in its stock price. However, despite these concerns, Varun Beverages delivered a strong performance in its Q4 results. The company's growth was driven by increased sales volume, supported by the expansion of its international operations. Additionally, a better product mix played a crucial role in boosting its performance during the quarter. With new product launches and improved offerings, the future looks promising, and it is reflected in the stock price as well. The stock of Varun Beverages has surged by around 28% in just the past month. The key question now is whether this positive momentum will continue. How does Varun Beverages plan to tackle growing competition, and what are the future prospects? Let's break it down. Welcome to Bottomline by Groww. I'm Radhika Bajaj. In today's episode, we analyze how Varun Beverages Ltd aims to sustain its earnings momentum and navigate the evolving market landscape. Before we go any further, let's understand this well-known beverage company a little bit better. Varun Beverages Ltd, or VBL, is a leading player in the beverage industry and one of PepsiCo's largest franchisees globally outside of the United States. Associated with PepsiCo since the 1990s, VBL has expanded its licensed territories, diversified its product portfolio, and strengthened its distribution network over the past 2 decades. The company manufactures, distributes, and sells a wide range of carbonated soft drinks and non-carbonated beverages as well under PepsiCo's trademarks. Its carbonated soft drinks include Pepsi, Pepsi Black, Mountain Dew, Sting, 7-Up, and Mirinda, while its non-carbonated beverages lineup feature Tropicana juices, Gatorade, 7-Up, Nimbus, and Aquafina packaged drinking water. The company also offers snacks, packaged drinking water, and value-added dairy products. Now, VBL holds franchise rights for PepsiCo products across 27 Indian states and 7 union territories, accounting for about 90% of PepsiCo India's beverage sales. It also operates in Nepal, Sri Lanka, Morocco, Zambia, and Zimbabwe. As such, while revenue from India contributes 72%, international business contributes about 28% as of FY24. Among the products, carbonated soft drinks contribute the maximum, about 74%, with juice and water making up for the rest. It's not like any other bottler or soft drinks maker. VBL has a dominant market share in the soft drink segment. The company has shown remarkable financial performance over the years. Take the last 5 years, for instance. From 2020 to 2024, the company's revenue has grown 22.7% CAGR. Similarly, its earnings before interest, depreciation, and amortization also has reported a growth of nearly 30% CAGR during the same period. And in terms of the company's profit, it has grown 37.1% CAGR. Further, the strength of the promoter's vision and execution has helped the company grow, with VBL accounting for 90% of PepsiCo's India volume sales. Despite such robust performance over the years, the stock is down about 23% since touching its 52-week high in July of last year. One of the primary reasons includes the entry of Campa Cola by Reliance Industries and the launch of its soft drink with aggressive pricing. VBL's products, though well established, are priced higher compared to Campa's, which may make them less attractive to price-sensitive consumers. A significant portion of consumers in India are still attracted to the lower-priced alternatives. This competitive intensity has raised concerns among VBL's investors and the eventual impact on sales volume and pressure on margin. The erratic monsoon season too played its role, though the company's performance remained quite steady throughout 2024. This apart, the stock had been trading at a higher trailing 12-month PE of 69.92 as of March 27, which is higher than the median PE of 59.6. As such, the overvaluation could have caused some profit booking. Having said that, Varun Beverages has all the levers in place for potential growth in the coming years. Its performance is expected expected to remain strong. Let's understand how and what are supporting factors for the same. Number 1. A key player in the soft drink industry and the largest franchisee for PepsiCo. VBL is a dominant player in the global beverage industry and one of PepsiCo's largest franchisees, accounting for over 90% of PepsiCo India's volumes. With franchise rights in 10 countries and distribution rights in an additional 4 countries, VBL serves over 1.4 billion consumers, covering nearly 1/6 of the world's population. As mentioned, the company offers a diverse portfolio of carbonated soft drinks, non-carbonated beverages, and packaged drinking water under PepsiCo's brands. Backed by strong manufacturing and distribution capabilities, VBL manages end-to-end execution across the value chain. With 48 production facilities, 36 in India and 12 in international markets, VBL has built a robust supply chain network. This includes over 130 depots, more than 2,500 primary distributors, and a fleet of 2,500 plus owned vehicles. To ensure seamless demand fulfillment, the company has installed over 1.02 million Visi coolers, reaching more than 4 lakh outlets. These efforts have contributed to market share gains, margin expansion, and long-term growth prospects. 2. Steady expansion to international markets. VBL continues strengthening its international presence, expanding its footprint across key markets. African regions present a significant growth opportunity, with VBL strategically expanding in regions where PepsiCo has a relatively lower market share compared to Coca-Cola. This is evident in its acquisitions in large markets like South Africa and Tanzania, as well as its ongoing capacity expansion in the Democratic Republic of Congo. That is, in 2024, the company achieved a major milestone by acquiring BevCo and its subsidiaries in South Africa. It also entered binding agreements to acquire a 100% stake in Tanzania and Ghana, further solidifying its African market presence. Additionally, VBL secured exclusive snack franchising rights for PepsiCo's brands in Morocco, Zimbabwe, and Zambia, marking its entry into the food business. It has 3 manufacturing plants under development in these markets, and they are projected to generate $100 million in revenue. The company has demonstrated strong execution in these regions, positioning itself as PepsiCo's preferred franchise partner. That said, VBL's international business faced challenges in 2024. This was primarily due to the introduction of a sugar tax in Zimbabwe, which led to a shift towards zero sugar products, impacting sales of sugary beverages, including energy drinks like Sting. Economic instability and slower consumer spending in some international markets further dampened demand. Additionally, investments in new manufacturing facilities, such as in South Africa, increased fixed costs and affected short-term profitability due to underutilized capacity. However, VBL's management remains optimistic about its global prospects. South Africa is expected to sustain double-digit growth, while the Tanzania acquisition offers significant potential, leveraging PepsiCo's dominant 56% market share in the country's carbonated soft drink segment. Ghana, though currently a smaller market for PepsiCo with a 13% share, presents ample room for expansion within its 15 to 20 million case market. A key advantage of these acquisitions is the ability to mitigate seasonality risks. Tanzania and Ghana have different seasonal peaks compared to India, helping VBL maintain more stable revenue throughout the year. Number 3. New product launches and enhancing product offerings. As mentioned, Varun Beverages is strategically expanding into the food snacking segment, positioning it as a key long-term growth driver. The company aims to diversify its portfolio through strategic partnerships in snacks and value-added beverages. Through its wholly owned subsidiary, VBL has signed an exclusive snacks appointment agreement to manufacture and package Cheetos in Morocco. The facility is expected to be operational in May 2025. This initiative complements VBL's existing distribution of PepsiCo's snack brands, including Lay's, Cheetos, and Doritos in the region. Additionally, VBL subsidiaries Varun Zimbabwe and Varun Zambia have entered into an exclusive snacks franchising agreement with Premier Nutrition Trading to manufacture, distribute, and sell Simba Munchies in Zimbabwe and Zambia. Distribution began in February of 2025, with manufacturing facilities set to launch by by the end of 2025 in Zimbabwe and in Zambia in April 2026. All these expansions strengthen VBL's portfolio and maximize synergies with its existing infrastructure in Africa. Now, beyond snacks, VBL continues to innovate in the beverage segment. The company is set to launch Sting Gold, a malt beverage in India in May this year. Priced at ₹20 for 250 ml serving, this launch builds on VBL's success with products like Sting energy drink, leveraging its extensive retail and manufacturing network. With a healthy pipeline of upcoming product launches, the company is well positioned for continued growth in both the beverage and snacking segments. For financial strength, in the recent December quarter, VBL experienced strong growth in sales, margins and PAT compared to last year, though it saw a decline quarter-on-quarter. This was primarily due to seasonal factors. Demand typically slows after the peak summer and festive seasons, directly impacting revenue. Lower consumer demand in these off-peak months usually results in reduced sales volumes and higher relative operational costs, leading to a drop in both revenue and profitability. Consequently, the margins as well. In terms of the company's debt, VBL's debt-to-equity ratio has significantly decreased from 0.76 times in 2020 to 0.14 times in 2024. The ratio dropped steadily over the years, but the QIP amount of 7,500 crore rupees raised in November 2024 helped reduce the debt in that year significantly. Now, QIP or qualified institutional placement is a method through which companies raise capital by issuing shares to institutional investors such as mutual funds, insurance companies and pension funds. Similarly, the company's debt to EBITDA ratio, another metric measuring a company's ability to pay off its debt using its earnings, decreased from approximately 1.46 times in December 2023 to around 0.58 times by December 31st, 2024. As such, the QIP funds raised in November 2024, which were used to reduce debt, are likely to lower the interest expenses in the upcoming quarters. But note that in 2024, VBL's rise in interest costs was primarily driven by a 95% year-on-year increase in lease liabilities. This increase comes from the company's ongoing expansions and acquisitions as it took on additional leases for new production facilities, adding to its interest expenses. That said, the company does face some challenges. First is competition. Varun Beverages faces growing competitive pressure, particularly in the domestic market due to the aggressive pricing strategy of Campa Cola. VBL's products, while well established, are priced higher than Campa's, making them less appealing to price-sensitive consumers. In a market where economic challenges like inflation drive demand for affordable alternatives, price elasticity remains a key factor. Consumers may switch brands if the price gap is significant. According to management, even before Campa's entry, about 20% of the market was already served by lower-priced beverages. However, Campa's rapid expansion could accelerate this trend, potentially impacting VBL's volume growth. While VBL maintains that its products do not directly compete with budget brands, the rising appeal of cheaper alternatives could erode its market share, particularly in regions where price sensitivity is high. This intensifying competition could lead to a price war, pressuring VBL to reduce prices to retain customers, which in turn would affect profit margins. Campa's low-cost strategy is especially effective in small towns and rural areas where brand loyalty to VBL may not be as strong. As a result, maintaining market dominance while balancing profitability will be a critical challenge for VBL moving forward. As such, to handle this, the company has taken a few initiatives by introducing budget-friendly products. For instance, the company introduces a no sugar and light variants at 10 rupees to take on competition. Second is valuation. As mentioned earlier, VBL's price to earnings ratio remains at elevated levels. Looking at its EV or EBITDA ratio, it has declined from a peak of 57.8 in July 2024 to 37.1 in March. While this reflects a drop in valuation, it remains above the 5-year industry median of 28.4, indicating that the company is still being valued higher than its historical performance. This decline is driven by factors such as rising competition, increased operational costs, and higher financing expenses from expansion projects. Now, despite strong growth prospects, particularly with new acquisitions, VBL's high EV or EBITDA ratio suggests a greater level of risk even after the correction. If VBL fails to meet its high growth expectations, future earnings disappointments or heightened threat from the competition could lead to further price corrections. So, having listened to both the positives and the challenges of VBL, what is the big takeaway? Well, VBL is well positioned to sustain its growth momentum. The company's expansion into newly acquired African markets, steady growth in India, ongoing capacity and distribution expansion with a 10% annual increase in outlets and increased refrigeration penetration in rural and semi-rural areas will drive its long-term success. Do you own VBL in your portfolio? How have your returns been? Share those views in our comments, and for more such insights, remember to subscribe to Bottomline by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.